So, you probably didn't know that there is a potential tax bomb, as some people have called it, uh, once you are actually retired. And it is something key and pivotal to know and understand about. Now, what am I talking about? I am talking about, of course, the required minimum distribution. You may or may not be aware that Congress and the IRS forces you to take income out of your savings, whether that's a traditional 401k or a traditional IRA or even a 403b, once you turn a certain age. Now, there have been a lot of changes recently when it comes to the required minimum distribution. The first change that I can think of most recently is with the passage of the Secure Act 2.0. And so they raised the required minimum distribution age from 72 to 75, but it's based on the year that you retire, or the year that you were born, rather. So when you look at retirement and you have to look at your birth year age, you need to be planning for the required minimum distribution, because that is a certain amount, and it's based on how old you are that year. There's a table that the IRS uses to calculate how much you have to take out. Now, there are a lot of rules when it comes to the required minimum distribution as well. So let's talk through some of the thoughts when it comes to a required minimum distribution, or RMD as it's called. First, when do you need to take it? Well, the IRS did just update, Congress just updated when one has to start taking the RMD, and it's based on your birth year. So if you were born before 1951, it's the previous age, 72. And then if you were born certainly a few years ago, or born a few years before that, then it was the original age was 70 and a half. Now they've bumped it back to age 73. So if you're born in the year 1951, it's 73. If you're born thereafter, for the next 10 years, basically all the way up until, I believe it's 1961, you then, it turns to age 75 as a required minimum distribution. So knowing the age of when you have to take out the money is important in your planning, because if you're younger than that, you may be thinking, well, I'm not 70 or 72 or 75, so I don't have to worry about it. Well, you want to start thinking about it much earlier, because if you don't, a lot of clients that I work with end up having to be forced to take more income than they really want to, because they might have other sources of income. Maybe they have non-taxable or tax-deferred assets, or non-qualified assets. Maybe there's a pension, maybe Social Security. All of that might be covering their income. So you need to be aware of the age, because there are some things that you can do planning beforehand so that you can take advantage of that. Now, what is a requirement distribution? It is basically the government wants to have for you to pay taxes on your traditional retirement savings. So the government incentivized you originally to put the money in because you get a tax savings on the amount that you put into a traditional account. However, whenever it grows, and now you're in your 70s, the government wants you to start having to take the money out so that you can pay taxes on that, because you have not paid taxes on any of that money up to this point. And so if you start at waiting until the requirement distribution, it might be much more than you really want to spend when it comes to that. The other thing to think about is, what are some ways to potentially avoid or mitigate the requirement distribution? There are several ways to do that. One of the most charitable ways is what's called a qualified charitable distribution, where one can give from their IRA, and IRA only. They can't give from their 401k, but they can give up to $100,000 a year to a charity of their choosing, and that count towards their RMD. Now, it is important to know, though, that actually can start at 70 and a half, when the old RMD age used to be. But Congress likes the idea of people giving to charity. That way, charities do a lot of good for society, and also can be funded by somebody other than the government. And so they want to give incentive to giving to charity. And so one of the ways they do that is by having the RMD charitable distribution as an option. Another thing with the RMD is, or another way to potentially avoid the RMD, is there are annuity contracts that allow you to purchase an annuity to then basically be used for later down the road for longevity and things of that nature. Those have been less appealing recently, but it's still good to know it is a potential option, especially if you might have a large RMD. For instance, a lot of people retiring from Disney, they have a pension, and so their pension and Social Security ends up being enough for their living costs, and so they end up having a good chunk in their old 401k that maybe now is an IRA that they have to take income from, and it ends up being a good bit of money, an extra taxable income that they may or may not actually want to take on. The other thing when it comes to RMDs is you cannot always aggregate your RMDs. So what does that mean? So let's say your traditional accounts is $1 million and your RMD for that year is $45,000, right? So, but you might have an IRA, you might have an inherited IRA, you might have a 401k or maybe a couple 401ks from old companies. You have to be careful on when and how you take the amount of RMD out, because of the fact that there are rules for each of those accounts separately, not necessarily where you can combine it all together. Now, sometimes you can, but sometimes you can't. So there are things to look out for there and be cognizant of. And lastly, the final thought on RMDs when it comes to traditional accounts is the fact that one may have, upon passing, there are also potentially RMDs that the beneficiary will need to take. And there are special rules and there are new rules in regard to that happened last year in the 2018 Act as well. And so we need to, whenever you're thinking about who is receiving the assets that you leave behind, whether it's an old 401k or old IRA, you've got to be careful of who they are, how old they are, and make sure to understand the tax ramifications towards them too, because that does impact potentially a beneficiary may end up having to take required minimum distributions for a period of time as well.